Welcome to a brand new cutting-edge analysis of the global financial markets, which currently stand at a pivotal juncture. There's a profound ferment beneath the surface, and while many investors cling to traditional assets, a seismic shift is underway towards real physical holdings. Today, we're diving deep into the reasons why gold and silver prices are not just rising, but literally exploding. We'll uncover a secret silver deal that could send the market soaring, and dissect the financial mess that governments worldwide have created. These are exciting yet perilous times where accurate knowledge is paramount for protecting and growing your wealth. Let's begin with the often underestimated of the two precious metals, silver. For a long time, it was undervalued and artificially suppressed by paper markets. However, that era is now drawing to a close. The reason is simple and fundamental: physical demand vastly outstrips supply. Industrial demand alone is set to consume nearly all of the global silver production this year. We're talking about roughly 840 million ounces from mines flowing directly into the manufacturing of rockets, tanks, nuclear power plants, solar installations, and countless high-tech applications. From e-mobility to artificial intelligence and laptops, modern industry grinds to a halt without silver. This industrial hunger for physical silver is the critical turning point. It's no longer sufficient to trade paper contracts on the market, settled in cash. Manufacturers urgently need the physical metal to produce their goods, which are in high demand from a functioning global economy. If you don't have silver, you can't produce. This imperative for physical delivery strips the manipulative forces of the paper markets of their power, brutally exposing the metal's true scarcity. The market, once considered insignificant with a volume of around $45 billion, is now becoming the epicenter of a massive supply bottleneck. Adding to this industrial demand is a rumor that, if confirmed, will conclusively shatter the market. Reports suggest that major institutions in China have issued silver bonds worth $15 billion. These bonds were issued when silver was around $26 and contain a crucial clause: if the price rises to $41, physical delivery must occur. This amounts to approximately 350 million ounces of silver. One can only wonder where such a massive quantity of physical metal will come from in a market that is already effectively depleted. This impending supply crunch explains the current momentum and the ambitious new price targets. The $46 mark is the next immediate goal, followed by $52 and finally $63. Reaching $63 this year seems entirely plausible. This wouldn't even be the much-talked-about squeeze, where short sellers desperately scramble to acquire physical metal. Should such a squeeze actually materialize, triple-digit silver prices are inevitable, as there would be no stopping the ascent. Patient silver investors who have held onto their investments for years could soon be richly rewarded. Now let's turn our attention to gold, the supposedly boring bedrock of finance. Yet there's no boredom to be found here. With a year-to-date performance of 40% in US dollars and 22% in euros, the yellow metal is demonstrating strength rarely seen in such a short time frame. We are witnessing a historic movement that leaves even seasoned analysts astonished. This surge is no coincidence, but the direct result of the financial chaos reigning worldwide. Gold is fulfilling its 6,000-year-old function as the ultimate store of value, at a time when confidence in fiat currencies and governments is eroding. The drivers for the gold price are not industrial, but are deeply rooted in the fundamental problems of our financial system. A glance at France suffices. The country, with a debt-to-GDP ratio of 134%, stands on the brink. Bond markets are already pricing in this risk. France is now paying significantly higher interest rates than reformed southern European countries like Greece, Portugal, or Spain. Greece is generating budget surpluses and paying down debt, a development Germany and France can only dream of. This debt crisis is a tsunami in the making. Germany is in no better shape, even if politicians prefer to obscure this fact. If the so-called special funds are fairly added to the national debt, Germany has also crossed the critical 90% debt-to-GDP threshold. Beyond this level, it becomes exceedingly difficult for an economy to achieve sustainable growth. Investors worldwide are now realizing the immense debt bubble that has formed in Europe and the United States. The flight from government bonds has begun, and the safe haven is gold. Price targets reflect this development. After $3,600, $3,900, and then $4,200 are the next milestones. The flight from bond markets is one of the strongest drivers for gold. Leading investors like Jeffrey Gundlach and Ray Dalio have declared the era of bonds over. Asset managers and pension funds, managing trillions, are genuinely afraid for the first time that they might not get their money back. The U.S. administration's idea of issuing 100-year bonds to solve the debt problem has only deepened this distrust. No prudent manager of pension funds can take such a risk. The logical consequence is a reallocation to the only asset that carries no counterparty risk: physical gold. This reallocation is confirmed and accelerated by the behavior of central banks themselves. In a historic shift, the Chinese now hold more gold than U.S. treasuries. Crypto companies like Tether are buying gold in large quantities and storing it in Switzerland because they distrust their own digital product. Even central banks like El Salvador's are beginning to buy gold. They have all understood that their currency reserves contain too few hard, incorruptible assets. Global allocation to gold, silver, and mining stocks sits at a paltry 2.4%. A doubling or tripling would be easily possible without overstretching. Another technical but crucial factor is gold's official recognition as a Tier 1 asset under Basel III banking regulations. Since July 1, 2025, gold has been considered 100% high-quality liquid asset (HQLA). This effectively legalizes gold for interbank business, making it more attractive for banks to hold gold instead of questionable government bonds. It's a blend of necessity to stabilize the system and the realization that the flight to gold can no longer be fought. It offers a way for large banks with their own gold vaults to navigate out of the current quagmire. Speculation about a revaluation of gold by the U.S. persists. An official gold price increase from the historical $42.22 per ounce to, for example, $4,000 would provide the U.S. with immense financial breathing room, alleviating its balance sheet by over $1 trillion. However, the crucial question remains how much physical gold is actually still in their vaults. The repatriation efforts by countries like Germany and Italy demanding their gold back from Fort Knox suggest significant doubts about its availability. The process has dragged on for years, fueling suspicions that the gold simply isn't there anymore. The situation in the futures markets, particularly on the COMEX, is also escalating. We are observing delivery months where 100% of contracts must be physically delivered, a phenomenon not seen since the 1960s. Normally, the delivery rate is 1 to 2%. This shift indicates that market participants no longer trust paper gold and are insisting on the delivery of the actual metal. Switzerland, as the world's largest gold refinery hub, plays a key role here. When the U.S. threatened tariffs on gold, Switzerland would have ceased shipments, which would have immediately caused the COMEX system to collapse. Amidst these global tensions are potential interest rate cuts by central banks in Europe and the U.S. While 96% of Fed observers anticipate an interest rate cut, this could open Pandora's box. The tariffs introduced by the Trump administration have not yet fully impacted inflation due to existing inventories. However, once these stocks are depleted and tariffs on imported goods like coffee or capsules fully take effect, consumer prices will surge dramatically. An interest rate cut in this environment would not curb inflation, but rather fuel it further. We could then see inflation rates not of 2 or 3%, but 6, 7, or 8%. While this might be a way for highly indebted states to reduce their debt, for the population, it would be financial strangulation. The gold price may have already factored in some of this development. The steady climb in a clean stair-step formation without major corrections indicates that any minor pullback is immediately met with massive institutional and private buying. This demonstrates that the market is underpinned by deep fundamental strength. The paradox of the current gold rally is that the broader investing public isn't yet involved. In the gold market, there's no FOMO, fear of missing out, but rather FOGI, fear of getting in. Many investors who considered buying at $1,600 too expensive are still on the sidelines today, watching the price rise relentlessly. The long-term forecast for gold by 2030 is $9,250. This increase will not be linear, but the trend is irreversible, driven by the fundamental dislocations in the global financial system that can no longer be ignored. For investors willing to take on higher risk for potentially higher returns, mining stocks offer an attractive, albeit volatile, alternative. When gold prices rise, the profits of mining companies often leverage this increase many times over. However, the sector hasn't truly taken off yet. The market still doesn't fully trust the current price surge, meaning the enormous profit margins of producers are not yet fully priced into their stock values. With average all-in sustaining costs, AISC, around $1,600 to $1,700 and a gold price exceeding $3,600, mines are achieving margins of over 100%. What other companies can boast such profit margins? While investors chase tech stocks like Nvidia with price-to-earnings ratios exceeding 500, the mining sector is egregiously overlooked. For inexperienced investors, it is advisable to focus on profitable producers or invest in broadly diversified mining ETFs. Exploration companies are extremely risky. Statistically, only 1 out of 1,000 projects goes into production. An ETF bundles the best companies, reduces individual stock risk, and still offers significant leverage to precious metal prices. Beyond gold and silver, other overlooked commodities are poised for a bullish scenario. A clear favorite is uranium. The sector recently experienced a breakout after the U.S. announced massive strategic reserve replenishment. Similar to silver, the uranium market has fallen into a deep supply deficit after years of underinvestment, while demand is exploding. New nuclear power plants are being built worldwide, particularly in China, India, and Turkey. This year alone, 12 new, large reactors are coming online, and existing power plants in the U.S. are extending their lifespans from 40 to 80 years. Demand for uranium will continue to soar when the new generation of small modular reactors, SMRs, goes into mass production starting in 2027. Companies like Rolls-Royce are already implementing these. The problem is that significant new mining projects will not go into production until 2032 to 2035 at the earliest. The supply deficit will therefore worsen for years to come, inevitably leading to sharply rising prices. Furthermore, every new nuclear power plant requires not only uranium, but also between 3 and 6 million ounces of silver for construction and ongoing operation, further fueling silver demand. Other critical metals such as nickel and graphite are also compelling. Nickel is dominated by Indonesia and China, leading to a dangerous dependency for the West. Projects like the Crawford deposit in Canada are therefore of strategic importance to secure North American supply. In rare earth elements, China's dominance is even more overwhelming with a market share of around 85%. Without these metals, no electric vehicles, hybrids, or hydrogen cars can be built. Europe must urgently wake up and accelerate the exploration and production of these strategic raw materials to avoid falling behind. The trend in battery technologies, however, could shift. In stationary energy storage, development is moving away from flammable lithium-ion batteries. This could long-term alter the demand profiles for lithium, nickel, and graphite. Nevertheless, the fundamental thesis remains. The energy transition and technological progress require a massive amount of raw materials whose supply is scarce. The combination of structural deficits, geopolitical risks, and a global debt crisis creates an extremely bullish environment for real assets, especially gold, silver, and uranium. However, the greatest danger to citizens' wealth comes not only from inflation or state bankruptcies, but from a targeted central bank project, central bank digital currency, also known as CBDC or the digital euro. This project, being pushed globally, is nothing less than an attempt to carry out the largest expropriation in history. It threatens not only the loss of our savings, but also our freedom. A digital euro would grant the European Central Bank total control over our money, and consequently, over our lives. When a state faces bankruptcy, historically there are three possible outcomes: a major war, hyperinflation, or currency reform. The introduction of a digital euro would be such a currency reform, enabling the transition to a new monetary system, a system coupled with unsettling functionalities. The central bank could impose negative interest rates at the push of a button, assign an expiration date to your money, or dictate what you can spend it on. Coupled with a digital ID that bundles all your personal data, a system of total surveillance and control would emerge. This scenario is not a distant dystopia. Preparations are in full swing. In Frankfurt, the Anti-Money Laundering Authority, AMLA, has already been established to monitor all payment flows in the EU. Politicians like Friedrich Merz openly discuss mobilizing citizens' savings to finance infrastructure. Ursula von der Leyen plans a savings and investments union with the same goal. These are thinly veiled announcements of future expropriation. The narrative of terrorism financing is being misused to abolish cash and force citizens into the digital system. The absurdity of this approach becomes apparent when considering the behavior of central banks themselves. While they aim to impose a new, programmable, and controllable digital currency on citizens, they are themselves fleeing to the oldest and freest money in the world: gold. The central banks of the BRICS nations and many others are buying record amounts of gold because they no longer trust their own fiat money system. This is the ultimate proof that a gigantic web of deception is being maintained. By now, every investor should understand the game being played. Politics in recent decades has repeatedly proven that it does not act in the best interest of citizens. Pension systems are collapsing, debts are unsustainable, and ideologies are detached from reality. One can no longer assume the good intentions of politicians. The decisions being made often serve only to maintain power and secure personal pensions. The digital euro is a tool to keep a bankrupt system alive for as long as possible by maximizing control over citizens and burdening them with the financial costs. What does all this mean for you as an investor? It is crucial to understand that your money in checking or savings accounts is no longer safe. Legally, it is merely an unsecured loan to a bank. In a crisis, your assets are liable for the system's failures. The only way to escape this grasp is through ownership of real physical assets. A debt-free personal property, physical gold and silver that you store yourself, and selected stocks of profitable companies in strategically important sectors like raw materials. Diversification is the key to survival in this environment. Stay away from government bonds of any kind. Pay off your debts to avoid becoming vulnerable to leverage. Build a broadly diversified portfolio of real assets. This includes physical precious metals, strong dividend stocks, mining stocks through ETFs, and for those who believe in it, a small allocation to cryptocurrencies. The goal is to create a robust portfolio that can withstand the coming storms, regardless of their origin. The coming years will be marked by significant upheavals. The fight for financial freedom will be waged on many fronts. It will be fought through resistance against the digital euro and digital ID, and through the conscious choice of cash and anonymous stores of value like gold and silver. Cash is living freedom. It allows for a privacy that is increasingly threatened in a digital world. Protect yourself and your assets by staying informed, understanding the connections, and making the right decisions for your financial future today.